From downtown Milwaukee, welcome to Money Talk with Bob Landis. Each week, professional advisors from Landis & Company Investments discuss the latest financial developments, offering timely insight and long-term perspective.
You're listening to Money Talk for May 1st, 2026. The Brewers are on the road this weekend in Washington against the Nationals. It's opening weekend at the Estabrook Beer Garden with festivities all weekend long, and the 152nd running of the Kentucky Derby kicks off down in Louisville. For those wanting a mint julep without the 6-hour drive, Maxey's is hosting their 19th annual Derby Day party. It benefits the Hunger Task Force, so technically, wearing a giant hat and drinking bourbon counts as community service this year. Speaking of community service, we have a brand new world record right here in our own backyard. The Milwaukee Riverkeepers officially secured the Guinness World Record for the most participants in a river cleanup. Over 4,000 hands belonging to over 2,000 volunteers cleaned litter across 120 different green spaces across the city. It's a huge win for the city and our beautiful green spaces. Down in Tennessee, things got a little bit crowded on the highway. A semi-truck carrying 1 million bees crashed, releasing its entire hive onto an exit ramp. First responders described it as a sticky situation, which is the kind of pun you make when you aren't the one being chased by a million stinging insects. Thankfully, no one was hurt, and the local beekeepers managed to wrangle most of them back into their boxes. No word yet on if the bees were charged for loitering, though. And your funny headline of the week. Man finally passes his driving test after 9 years and 139 attempts. Somebody please just get this man a bus pass. On the podcast today, we have Steve Giles, Mike Hoelzl, and wrapping up the week, here's Kyle Tetting.
Well, thanks, Jason. A good week overall. Nasdaq up 1.1%. That's 282 points on the week to close at 25,119. The S&P up 0.9%, up 67 points on the week. And the Dow up 0.6%, despite falling 139 points on Friday, up 283 points for the week. For the year, Nasdaq up 8.2%, including dividends. The S&P up 5.9%, and the Dow trailing, but still up 3.4%. Mike, hard not to look at the week overall and be encouraged, obviously, by the returns we've seen in the market, but a lot of data this week, a lot of economic data. We got about 40% of the S&P's earnings come out in a week, and perhaps as important as anything else, Jay Powell's last meeting as chair of the Federal Reserve on Wednesday. No change coming from the Fed, but what else did we learn?
Well, we learned he's the first Fed chair to not step down since Mariner Eccles, who before that was the nautical professor at Hogwarts, I believe. No, I mean, one of the things that we learned was four governors dissented in terms of keeping the rates the same, which is the highest dissension rate since October of '92. So you can see there's some real debate going on in that room of whether they should keep rates the same or cut them. It doesn't seem like there's a real appetite to hike, even though there may be some inflation concerns percolating in there. But in all seriousness, it is interesting that Powell is sticking around, right? I do think that he's sticking around in part to kind of stick it to the president a little bit, who kind of put him through the ringer somewhat. But it is also, I think, reasonable to say that he really believes in what the Fed does and wants to continue the balance that it has, right? Because there have been rumors that Kevin Warsh, which I'm going to stumble across that name a lot just because of the R in there. I keep wanting to call him Kevin Wash. But he seems to have a mandate from this administration to drive rates down hard and fast. And it seems like some of Powell's comments is he's going to stick around to try and not necessarily prevent it, but I'll give a dissenting voice in there so maybe they don't cut as fast as some people want.
I think the independence of the Federal Reserve has been such an important tenet of the body itself for really from its very beginnings. And so in many ways, Powell's ability to help navigate this transition, I think an important part of maintaining that independence. I think, Steve, part of the problem is that we have a pretty big divide between what we are seeing from a inflationary front and what we are seeing in other areas of the economy. you pointed out in some of your notes looking ahead here that it's really a tough position to be in for the Fed when we have this Iran war hanging over our heads. The prospects of continually higher oil prices certainly should give the Fed some pause about the cuts that perhaps the administration is leaning into. But what are you looking at as you kind of digest what we learned this week?
Well, so for our listeners, understand that when the Fed lowers rates, it's in an effort to help stimulate the economy, which is why everybody kind of cheers rates going down. The problem with that is that it also acts as an accelerant for things like inflation. And in an environment where you already have inflationary tailwinds coming from oil being over $100 a barrel, and the uncertainty of how long that price of oil is going to stay there, lowering rates may seem to be something that would only cause inflation to go higher at a time when I'm not necessarily sure consumers want to see the prices of goods and services go up.
Yeah, I think part of the challenge we face is that the cause of inflation is not necessarily low borrowing costs. And so when we look at kind of historical drivers of inflation or historical drivers of trying to increase growth, the idea that the Fed would cut rates, it might stimulate some economic growth, might stimulate some capital expenditure. Well, if you're also facing down the barrel of those higher oil prices, it might not have the same immediate impact. And I think the problem we face more than anything is that there is so much lag to these actions by the Federal Reserve that if we are in an inflationary environment, also cutting interest rates, which, Steve, to your point, could further exacerbate the problem, we may not even be able to fully digest the consequences of those actions for 6 months, 9 months, a year. And so you have a Fed that is probably now surrendering control rather than a Fed that, at least up till now, has been very data-driven, very particular in the ways that they are navigating these issues.
And on top of that, consider coming on the coattails here of how strong earnings have been, you lower rates in an effort to stimulate the economy. And we're now looking back at quarterly earnings that have, at least from where we're sitting, don't seem to be stimulated with how strong they've been.
I do not envy the job that Warsh has coming in. I think Powell, for all the knocks against him, did a fairly decent job of keeping investors, keeping market participants informed on what the Fed's thinking was, what the path forward was. Warsh certainly has some different ideas about how that might evolve. It's yet to be seen what that means in its entirety, but I do think tough to start this role in an environment in which a lot of the issues you're tasked with dealing with may be entirely outside of your control.
It's absolutely okay to take a wait-and-see approach. I think that if the Fed just continues to rely on the data and doesn't do anything, that isn't going to necessarily be a bad thing, just so long as they don't make a misstep one way or the other.
Yeah, I think that's fair. Mike, we hit kind of the heart of earnings season this week. Some pretty wild responses to earnings releases. And to be clear, a lot of it had to do with the fact that those earnings releases were largely massive surprises to the upside. We had talked last week, looking at the earnings expectations as of last week, Friday, something like a 16% earnings growth with what had been reported and what we were still forecasting for the first quarter year over year. All of a sudden, we got another 200 or so companies in the S&P report. This massive jump now to potentially north of a 27, 28% rate of earnings growth in the first quarter. No wonder some of those stocks jumped as big as they did. No wonder the market's been as rewarding as it has. What are you seeing as we kind of work through the bulk of earnings season here?
Well, I mean, like you said, the numbers you just read are, I don't want to use the word unprecedented, but I mean, to go from 16% earnings growth to 27 in the span of a week is just such a massive jump. It's hard to really put into words what that is. But I mean, you saw some really big companies have over, a 10% jump this week, like Caterpillar, who, if anyone has been listening to the pod, Kyle shouted that out 6 months ago. Better late than never. But no, you look at some of the earnings growth, and it just kind of all leads into what you guys have been talking about in terms of it all ties together, right? With the rate cuts, do they want to cut hard and fast? Because what you're seeing now is there's good and bad with the economy, but the market itself, if kind of, again, this is not going to sound the greatest, but we have to talk about the Iran war and kind of these market effects. If you can put the Iran war in the rearview mirror, we're looking at a pretty good year in the market based off just this data that you just read off. So I think it should be fairly encouraging for investors that, again, it's not all sunshine and puppies, but that data right there shows that if we can put the biggest headwind that we're facing behind us, you're in for a pretty decent year in the market.
Yeah, we love our sunshine and puppies, of course,
doesn't?
but you do have to factor in Iran because all of the forecasts we're talking about, all of the expectation are weighed on by the fact that if the Iran war continues, oil prices continue to spike, and the consumer's ability to spend and businesses' willingness to spend amidst that uncertainty is going to change drastically. And I think what has really helped near term is this massive spending that has been taking place in the AI space, in a lot of the warehousing and manufacturing build-out space. It's one of the reasons why we were as constructive on industrials overall as we were. You can't have these data centers without the tractors you need to clear the land. But when we look bigger picture, again, it's all about earnings and interest rates until something comes along to shift our expectations.
Yeah, I mean, well, as I said, if we put it behind us, but if we don't and this drags on, then the numbers you read are going to look substantially different, most likely to the negative going forward. So it's just, it's very rare that you just have one thing. I mean, again, there's some subsections of things that play into the market, but just one thing. I tell clients all the time, I can, for the past 2 months or so, I could tell you what kind of day I was going to have just by the headline in the morning, like overnight headlines. Peace talks are going well. All right, great. Market's going to do well. Oh, peace talks are collapsing. Oh, well, here we go again. So it's the one thing right now that is just kind of affecting whether we have a solid or just a kind of an year in the market.
You know, I do think it's worth going a little bit deeper, though, Kyle, on these earnings numbers, because consider that while the market has been driven by, I think, liquidity, AI earnings, and momentum more so than valuations. And as much as we talk about the markets move based upon interest rates and earnings, at some point valuations are going to catch up with everything. What does that number look like, and how do we prepare for the day when valuation comes knocking?
Yeah, forward PE on the S&P 500 now 21 again. We had gotten back below 20 for a little while. I have been of the opinion that, first and foremost, a higher forward PE is to be expected in this type of market environment. That lower rates than what we've seen historically, even the highs recently for interest rates, have been far lower than the typical high interest rates we see. That's supportive of higher valuations. Add in that profit margins for S&P 500 companies are exceptionally high and growing. That's supportive of higher PEs overall. And then, again, I think investors are looking at the world around them and going, well, yeah, I might have to pay up a little bit for some of these businesses, but what are my alternatives? They're willing to pay up. And so an earnings yield, 4.75% right now, forward PE of about 21. Yeah, okay, those are a little rich for my blood, maybe not quite as attractive as they could be. The way out is growth, is earnings growth, right? Because the alternative is, right, it's price over earnings. Either you grow your earnings, you grow that denominator, or your numerator takes a pretty big step down.
And I do hope that we have this rising tide lifting all boats, because market leadership has been somewhat narrow this year. So if earnings have been as spectacular as they have been, even though the market leadership is somewhat narrow and contained, we might get some spillover into other areas that have lagged a little bit.
No, I think that's fair. And the best news I can offer is that with money being spent, it might be spent by a technology business, right? It might be money coming off of Microsoft's balance sheet. But when it's spent, it's not always going to another technology business. It might be going to that Caterpillar, right, buy another tractor. They came out this week and said they have this massive backlog of heavy equipment. maybe it's going to the utility, maybe it's going to some other industrial. Well, okay, now that money doesn't just stop there either. It's got to make its way again through the next level of this system. And so I think there is the potential for a lot of that spending that's taking place to accelerate its way through the system. It would hopefully bring up a lot of those other businesses along with it because, to your point, we had a market that at least short-term early in the year seemed a bit broader. We got that Iran sell-off, and now it has seemed to come back to a small number of names leading. But that wasn't the case at the start of the year. And so if we can get back to some of that, if some of that spending can accelerate into other areas, it's going to help everybody.
I think it's fun that we can get down in the weeds here talking about things like this on our Friday podcast. But at the end of the day, I still remind clients that you want to pay attention to your allocation. And for those people that were worried when the market went down in March because of what was happening in the Middle East and wanted to sell or get out, they missed that entire upside. I think the month of April was one of the strongest S&P months that we'd had in years, up over 10% for the entire month. So again, don't try to time the market. It's all about the allocation, what your starting mix is. Trust the process, and don't be reactionary with what you want to do.
Yeah, a negative number on the S&P in the first quarter, and then one of the best months we've seen in many, many years. And so, again, that perfect reminder that if you didn't have a plan going in, you probably reacted the wrong way. If you had a plan, turns out it actually probably worked out pretty well.
To your point, Steve, it was very interesting to, I'm sure you had clients call on April 14th or whatever, 13th, and they're like, I just opened my statement, it's totally negative. And then you looked, and you pulled up their accounts on the screen, and it was completely positive. And they were like, oh, never mind, I'm okay. We'll talk again later. But if they weren't, or they did try to time the market, they didn't get back above water. They may still not be back above water because of how things are going.
Yeah, a few economic data points this week. Quite a few released, a few that I think are pretty worthwhile to look at. Mike, one of the big ones for us is always consumer confidence, right? How do people feel about the world around them? A little better than it's been, but maybe still not great?
Not great is, I think, an understatement for a lot of people. I mean, when I talk to clients, the prevailing thought is how expensive everything is. And again, we've said this on the show numerous times, and this isn't the most original thought, but so many people, when they drive past their local gas station, that will ultimately tell them how they feel about what's going on in the economy, right? Like, driving by, it's like, oh, I think I'm going to get gas. Never mind, I'm just not going to drive this weekend because they see it up at $4.59 or $4.79. And then that can ultimately kind of sour their mood on just the entire economy because it's right there in front of their face that things are more expensive, right? And so I'm very interested to see, because here in Wisconsin especially, where like gas has popped pretty good and they think it's going to continue to go up. I'm curious to see the number next month as well, because I do think we could be in for a drop if that continues to go up. Again, that's a pretty kind of basic analysis of consumer confidence, but it's kind of on like the everyman level of, oh, things aren't going great because gas prices are super high.
Yeah, buried in that conference board reading was a consumer expectation for the jobs market, and consumers feeling a little bit better about the labor market overall. And then, Steve, we got the best reading we've had for initial unemployment claims in a month in 50 years. The Federal Reserve has kind of that dual mandate of inflation plus jobs, a little more ammunition potentially for the Fed that maybe they don't need to be cutting.
Yeah, it was a sign that the labor market isn't in free fall. So for the Fed just throwing more things on the table that can make their job even harder.
Yeah, and so maybe the other one to point out this week was the initial reading for GDP for the first quarter, a 2% rate of growth at an annual pace, a healthy reading overall for the economy, and maybe not the 3.25, 3.5 that many of us are hoping the economy can get back to, but still solid growth for the GDP number overall. And buried in that is a reading on the Personal Consumption Expenditure Index, the Fed's preferred measure of inflation. Core PCE up 3.2% for the 12 months ending March, so well ahead of that 2% pace. As we continue to keep an eye on earnings and interest rates, well, the earnings piece looks great. Got a lot of questions about what's going to happen with interest rates as we continue to navigate inflation and we continue to navigate the jobs market.
You know, Kyle, that's the highest inflation reading we've had since November of 2023. That's 2.5 years, which is probably why consumers are feeling so fatigued with high prices.
Yeah, and reasonably so, right? That especially for lower earners, especially for those that are maybe
fixed incomes.
You got it. Struggling month to month to make ends meet. Those energy prices hurt a lot more than they do for somebody that's got more disposable income. And so I think the further we go down that path, the more consumers are going to start to feel that crunch. You start to see it in the GDP numbers. You start to see it even more in consumer sentiment. And so we've got to be really careful in navigating those issues.
Well, you know, it begs the question, how much better would the GDP numbers be if we didn't have inflation as high as it was, right? If inflation wasn't as high as it was, consumers might be out taking more road trips. They might be going on more vacations. They might be eating out more. And because they're not, GDP numbers have waned.
No, I think all that's fair. Well, we enjoy doing the program for you. We will talk to you again next week.
Thank you for listening to Money Talk with Bob Landis. If you have a financial question you want answered on next week's show, email it to moneytalk@landis.com. To keep informed throughout the week, visit our Money Talk page at landis.com.